traders and market movers. This is The Pulse with Francine Lacqua.
Good morning. You're watching The Pulse. I'm Guy Johnson. I'm in for Francine Lacqua. As I say, we are going to get data dropping throughout the next hour out of Germany, out of the regions, which will give us a clue as to what we are seeing in the bigger picture, the German picture, which will obviously ripple through into what happens in Frankfurt at the ECB. Brandenburg, August, CPI rises 1.7 year on year. Saxony, the number there, 2.6. So a fairly kind of mixed bag in terms of the year on years. I think I've got Bavaria at 2.1. Pretty consistent with the kind of mid-twos number maybe coming out of Germany. We'll get Baden-Württemberg, we'll get North Rhine-Westphalia a little later, and then we'll get the wider number a little bit later on. As you can see, a little bit of weakness creeping through into euro-dollar on the back of this as we see some of this data coming through. It's going to be interesting to see just how much strength we see maybe in the wider number. What is interesting out of the Spanish data is that actually the expectation, certainly from Bloomberg Economics, is that we do see actually this being the low point, and actually the energy effect comes back in and pushes that number higher. Hess is coming through now at 1.5. That's actually significantly lower than previously. In fact, all of these numbers actually look really quite down quite sharply versus the prior numbers, which is why you're getting maybe that weakness creeping into the euro. The euro maybe get flirting with 111. We've seen some recent euro strength. Maybe we're starting to back off that a little bit. Other stories that I want to focus on as well, that we are seeing now that we are getting potentially a meeting between Xi Jinping, the leader of China, and the US National Security Advisor. We're going to see the Sullivan-Xi meeting. We think that's going to happen later on today. We're going to get more details on that, and we'll work our way through exactly what we're going to learn from that meeting and what details are actually going to be disseminated to the wider world. In terms of the single stock stories we're watching this morning, a little surprised that actually we're not seeing more of an Nvidia read across. But look at Nvidia. It has bounced back. You could argue Nvidia is now only down 2.1 in the pre-market trading that we're watching right now. CrowdStrike is down, unsurprisingly, given what it's just said. Salesforce as well, some softness there. The Salesforce numbers are actually okay. They're going to focus on profitability, but just kind of the concern here is that we may be starting to see some weakness creeping in related to the AI story and a lack of demand for maybe Salesforce's CRM products, and that's being reflected in the stock this morning. But tech down a little bit in the States. But the expectation was that we were going to see much, much more, and that has not come through. The market seems to be actually largely shrugging its shoulders at the Nvidia story, which is really interesting. Nvidia's chief executive, Jensen Huang, reassuring investors, you could argue in some ways, by saying basically it's jammed tomorrow. We're going to get this Blackwell chip coming through later, and actually this is just a short-term blip in terms of when we're going to see that ramp coming through of that next generation of chips. He spoke to Ed Ludlow. Take a listen.
We're expecting Q3 to have more supply than Q2. We're expecting Q4 to have more supply than Q3, and we're expecting Q1 to have more supply than Q4. And so I think our supply condition going into next year will be a large improvement over this last year.
Robert Lee, senior analyst at Bloomberg Intelligence, joining us now to think about what we learned from Nvidia overnight. The market's reaction initially was quite negative, but we've come off the back of that with a more sort of maybe positive take. What is your thoughts on how we should be analysing these numbers? How bleak were they? How bleak was the kind of the issues around Blackwell? Because the initial reaction was negative, but as I say, that's being sort of tempered now.
Yeah, I think the fundamental outlook for the business remains unchanged and remains positive. I mean, they've got the market to themselves, and that will remain the case through to early next year and probably even beyond that. We got reassurance that this Blackwell product, although there is residual risk into next year, is getting back on track. And Jensen Huang said it could generate several $billion of revenue towards the end of their fiscal year. We saw some evidence that they're beginning to diversify their customer base, both geographically and also away from these very large tech platforms, the hyperscalers, the Metas, the Amazons, etc. of this world. So those were the positives. But again, I think time and time again with Nvidia, on a stock that has performed so well, that's trading on such a punchy valuation, I think there were expectations in the market that they could beat numbers by a more significant degree, and obviously that didn't happen. And although their guidance was a little bit above, again, the second derivative, if you like, the rate of incremental beat has been slowing down. I think also, just very briefly, if you take a step back, whilst the business is still reporting triple-digit percentage growth, the annual growth rate is slowing. A quarter ago, it was 260% or thereabouts. It slowed down to the 100% range, and going into the coming quarter, it's going to slow into the 70% range. So again, 70% is a great figure, but there is a marked slowdown happening.
In terms of the kind of the bigger picture around Blackwell, talk us through the manufacturing challenges that we're seeing with Blackwell. Is that something that I can extrapolate further out? Blackwell is going to be the next generation, and clearly it is complicated, and clearly it is a huge challenge to get the yields to where this company wants them to be. What comes after Blackwell? Do the challenges get greater in terms of the manufacturing story?
Again, you're making me think here. That's a great story, because one of the big advantages of Blackwell is the silicon real estate, if you like, has got bigger. It's a much, much bigger, more complex chip. But when you go through this fabrication or manufacturing process, it only takes one little error on that massive piece of silicon to effectively write off the whole device. So whilst you can sell these very large chips at a very high SP, the manufacturing risks and fabrication risks become much greater. So I guess the next generation, we'll have to wait and see, may involve even larger, more complex chips, or it could be a combination of smaller complex chips all networked together. But the problem they've had more recently is trying to connect and network these things together. Again, they're sort of at the bleeding edge of technology there. It's a non-trivial task to overcome. But, if there's anyone who can do it, TSMC, their partner, with the likes of Hynix and Nvidia together, that's a great team.
In terms of the optimism around the hyperscalers and the continued spend, do you buy Jensen Huang's optimism there?
Well, obviously, he's got the order visibility, and the outlook, into middle of next year or so looks pretty robust, because, as I've mentioned before, this is a bit of an arms race at the moment. Fear of missing out is a major driving factor at a point where these companies are really not monetizing to any large degree. But as I've said before, I think at some point, maybe into next year, we'll get the day of reckoning. If the monetization is not coming through at a fast enough rate, the risk is that they start to ease back on the capex, and that is a risk, a medium-term or 12-month plus risk for Nvidia. And I think, again, that is something that people are beginning to focus on to a greater degree than they perhaps did 2 or 3 quarters ago.
Robert, thanks for the continued update. We really appreciate it. Robert Lee, Senior Analyst at Bloomberg Intelligence, on what is happening with Nvidia. Just to update you on the pre-market, which kind of flips it at 9 London time, so we get a better idea. It takes maybe a little bit while to get the necessary volume to go through to give us a proper price. But as you can see, Nvidia looks like it's down 5 and a bit in terms of the percentage performance. So we're trading down a little bit more than maybe the initial boards that we posted seem to suggest. Sophie Huynh, Senior Cross-Asset Strategy at BNP Paribas Asset Management, joins us now. Big tech has been a big driver of global markets. Get a little bit of a wobble from Nvidia. How worried should we be?
I think it's actually the green light to rotate out of the Max 7 mega tech into the rest of the US equity market and into other regions such as Europe. So that's why also Europe is faring better this morning. And also into Asia, where the expectations are so low. And it's kind of like confirming the switch out of US exceptionalism into where the expectations are currently very low. The bar is very low for to surprise to the upside. So we think Europe and Asia are much more attractive.
But the macro story behind them isn't great. I look at Europe and I look at the data that's coming out of Europe at the moment. It doesn't exactly paint a positive picture at the moment. Yeah, Europe looks cheap, but Europe's looked cheap before hasn't necessarily been a great buy signal.
I think if you look under the bonnet in terms of consumer health, the consumer balance sheet is much better. If you have a continuous fall of inflation going from here, the real disposable income is going to be boosted as well. And I think the fact that they have already started their cutting cycle, look at what's happening with New Zealand. The consumer confidence, in terms of business outlook, is now at a 10-year high. So we never know what could happen, but in terms of expectation, I feel like it's much better to rotate out of the US right now than continue to keep your crowded trades in the US.
So you think cyclicals are maybe the way to go? You think the consumer comes back? I was talking to Michael O'Leary at Ryanair. I mentioned this yesterday. He was saying that he thinks high rates have caused consumer weakness this summer, and he thinks if rates come down, that consumer weakness story will rebound. So you're confident that relationship will work fairly quickly. Monetary policy normally works with a lag, but you're saying we could see it quite quickly.
I think we could have a blip up in the next couple of months. It's kind of this late cycle trade that could basically work. I think what usually happens when if you look at the OECD leading indicator, we're currently into expansion mode.
Yep.
If you look at history transition matrices, there's a 50% probability that we end up in a slowdown in 6 months' time. What usually happens when you move from expansion into slowdown is that you're going to have like a massive rotation within equity sectors. At the late stage of the cycle, cyclical tend to outperform defensive. I think in Europe, that's where you could have a bit of opportunity at this point.
Where does the cycle roll over, though? Like, can we park the recession risk? Is this a soft landing scenario?
I think at this point it's too early to fully reflect a recession into asset prices and portfolios. Having said that, if you look at how soft landing is currently priced to perfection, how central banks are also expected to cut back to neutral in a perfect way in a year's time, I think it's time to consider how much risk you want to put in portfolio, as well as what kind of risk.
If I'm worried about that downside risk, do I just buy bonds? Is that where I protect my portfolio?
So I think that's where the caveat is. If you look at the equity bond correlation, it's flipping negative. So it's raising the question on whether you're allowed to take a bit more risk because govies are back as a portfolio hedge and portfolio
So I can feel more confident in my portfolio that if it goes wrong, I've got the hedge on the other side.
But the problem is central banks are already priced to go back to neutral. So for bonds to rally further, you either need a faster pace of cuts, so this jumbo 50 bips cuts, or central banks to cut below neutral.
But the central banks are priced to go back to neutral. That's the kind of soft landing scenario. If you get a hard landing scenario, they go below neutral.
But there's going to be a price to pay for further monetary easing, meaning that risky assets, given that global risk premia are broadly very tight, they are not going to be okay. So that's why I think it's too early to have a recession in portfolios, rotate out of the crowded trades, but sprinkle with cheap value trades that could benefit from the current environment.
Do I have to be brave to do that? Because if I've wanted my portfolio to outperform over the last year, I've had to have been in the US, I've had to have been in tech. Is it going to make... You must have talked to a lot of people about it. Does it make people nervous putting that trade on coming out of the tech story? Because that's been my alpha over the last year.
I understand it's been a lot of momentum playing, but if you look at what's being priced at this point, US exceptionalism is still embedded into US asset prices, which is not the case in Europe and Asia. And that's the region that tends to benefit the most as you're into a late cycle kind of a setup.
How do I think about a weak dollar in my portfolio? What effect does that have? Because we're starting to see it come through. The euro's weakening up a little bit this morning, but up until now, the FX story hasn't had much of an effect, and it's now beginning to have an effect.
I'm short dollar. It's been all the sell side, like most of them are bullish dollar, especially with US election. I think this cycle is going to matter much more. I think the dollar smile that a lot of people talked about is going to be crooked this time around, because what's still embedded into US dollar is US exceptionalism, the resilience of US economy, as well as very sticky bullish bets still into the US dollar. So in the next 6 months, I think the dollar has room to fall further. And that's why having some yen, but having also some cheap high beta DMFX, such as the Aussie, Noki, the Swedish krona, really makes sense.
It's great to see you. Thanks for stopping by to see us. Really appreciate it. Sophie Huynh, Senior Cross-Asset Strategist, joining us from BNP Paribas Asset Management. Talking of asset management, let's talk about what is happening at HSBC. The global head of wealth and personal banking at the bank is going to be stepping down. Nunos Matos is going to be leaving, along with the company's COO, John Hinshaw, and the global chief of human resources, Elaine Arden. The departures come, of course, a day before we get the incoming CEO, Georges El-Hedri, taking the helm of this bank. Some of this was largely expected. There was obviously an expectation that we're going to be seeing some of those that didn't become, like Nunos, the CEO, maybe stepping aside. But he's not going to go straight away. That's more of a story for maybe a few months down the road. We'll come back to that story a little bit later on. Coming up, we're going to take a closer look at what the latest data coming out of Germany reveals about the state of its economy and the Eurozone. We'll have that conversation next. This is Bloomberg. So as we've already indicated, we're starting to see some data coming out of the German regions, the states. The CPI performance that we're seeing thus far seems to indicate actually that maybe the data are going to come through softer at a national level. Certainly that seems to be the state indication that we're getting at the moment. The euro is under pressure as a result of this. You can see the drop that we saw when we started to get that regional data coming through. We're going to get the German data a little bit later on. What should we therefore anticipate? There is but one person to ask. Ollie Crook joins us now. Earlier joke, bad joke. Ollie, the indications are from the States that we're going to see a soft number.
Absolutely. So listen, let's just set up what the market was anticipating in terms of coming into this number from Germany. What we're expecting month on month is a 0% inflation print in Germany. That's going to come a little bit later, 2.2% on the year on year. What we're seeing from the regions is actually month on month, every single region had a negative print, i.e., I think that if I can make a bold call, we may actually get a negative print at the national level for Germany.
Month on month.
Month on month, right.
Yep.
And again, we saw also in every single category, whether it's month on month, year on year, in every single region, the inflation numbers have come down. So the story is intact as far as we can see. And as far as the traders are concerned, we're seeing the same thing. The euro session low. I mean, we were talking about euro at 112. We crossed through to 110 now. And we look at the market pricing for the cut in September. It's now in excess of 100% probability. So the market's feeling pretty confident on that.
Pretty confident on a 25 bip cut.
Yeah.
Maybe it isn't 25. Maybe we get more. I don't know. But certainly the suggestion is we are going to see that cut coming through. Let's talk about the car sector.
Yeah.
Vitally important to Germany, and we've had some data out from Europe which seems to suggest an ongoing shift away from gas-powered cars, but also away from EVs towards hybrids.
This is really interesting what we got from the July print, because we've been obsessed with the EV story for years. We, of course, we're talking about the years before that, the shortage, and there was a lot of pent-up demand for all of these cars. That has shaken out a little bit. In terms of the headline number, in July in the EU, the deliveries were up 0.2%, very, very low. But as you say, when you break down the engine types, I mean, this is fairly remarkable in terms of what we've seen. EVs were down 11% in the month of July, gas cars down 7%, diesel down 10%. Hybrids up 26% in the month of July. So you see that rotation from all these different categories going into the hybrids. And again, when you see what that means in terms of the actual brands, I mean, Tesla was down 15% in terms of its deliveries in the month of July. Volkswagen down 2.2%. Stellantis down 5%. So again, this is a broader sector story. This is not just an EV story. This is across the sector. What is interesting is you did see a bit up. BMW and Mercedes both did a bit better in the month of July. You can see they're up about 2 and 3% respectively. What was interesting is that despite that and those sort of higher-end brands doing well, when you look at the Volkswagen numbers breakdown, Porsche down 15% this month.
That's amazing, isn't it? Yeah, really strong number to the downside. It's interesting, everybody laughing at Toyota for doing the hybrids. Maybe that trade has definitely come good. Ollie, thank you very much indeed. Ollie Crook joining us on what we're seeing out of Germany and also the auto sector across Europe. We're going to talk much more about what is happening with the macro story next. That is coming up. This is Bloomberg. Jake Sullivan, the US National Security Advisor, is in China, and we're starting to get a readout of a meeting that he has held with the Chinese Premier Xi Jinping. This is coming to us via CCTV, the Chinese state television. Xi indicating that he hopes that the Chinese and the US can find a way to get along. He says that China is striving to ensure ties with the United States are stable. Hopes the US will take a rational attitude towards China and that they can meet them halfway. This, of course, ahead of the US election, which is critical. We're going to talk more about Nvidia next. This is Bloomberg. Approaching half past the hour. Welcome back. You're watching The Pulse. I'm Guy Johnson in for Francine Lacqua. Let me give you a quick update on the top stories we're watching this Thursday morning. Nvidia falls in pre-market trading. This after a disappointing forecast and production snags with its much-awaited Blackwell chips. Revenue more than doubled. HSBC unveiling sweeping management changes, including the departure of 3 top executives. This as incoming CEO George El-Hedry prepares to take the reins next week. Plus, inflation firmly in focus. The euro falling to its lowest level against the dollar in a week after data showed German regional inflation slowed sharply in August. Spanish CPI also cooling to a one-year low, though expectations there are that we're going to see that number bouncing back. Let's take a look at what is happening with Nvidia pre-market. We're down by 4.5% right now, keeping an eye on what is happening here and the ripple effects that come off it. Nvidia's chief executive, Jensen, Huang, tried to reassure investors last night. He did so, A, on the call, and B, in an exclusive conversation with Bloomberg's Ed Ludlow.
We made a mass change to improve the yield. Functionality of Blackwell is wonderful. We're sampling Blackwell all over the world today. We show people, giving tours to people of the Blackwell systems that we have up and running. You could find pictures of Blackwell systems all over the web. We have started volume production. Volume production will ship in Q4. Q4, we will have billions of dollars of Blackwell revenues, and we will ramp from there. We will ramp from there. The demand for Blackwell far exceeds its supply, of course, in the beginning, because the demand is so great. But we're going to have lots and lots of supply, and we will be able to ramp starting in Q4. We have billions of dollars of revenues, and we'll ramp from there into Q1, into Q2, and through next year. We're going to have a great next year as well.
Jensen, what is the demand for accelerated computing beyond the hyperscalers and Meta?
Hyperscalers represent about 45% of our total data center business. We're relatively diversified today. We have hyperscalers, we have internet service providers, we have sovereign AIs, we have industries, enterprises, so it's fairly diversified. Outside of hyperscalers is the other 55%. Now, the application use across all of that data center starts with accelerated computing. Accelerated computing does everything, of course, from the models, the things that we know about, which is generative AI, and that gets most of the attention. But at the core, we also do database processing, pre and post processing of data before you use it for generative AI, transcoding, scientific simulations, computer graphics, of course, image processing, of course. And so there's tons of applications that people use our accelerated computing for, and one of them is generative AI.
CEO of Nvidia, Jensen Huang, speaking to Bloomberg's Ed Ludlow. Ben Barringer, global technology analyst at Quilter, Cheviot, joins us now to give us his take on all of this. Fairly negative market reaction, Ben. Is that the right reaction?
Look, it needs to be put into context. Nvidia has been beating its quarters by about $2 billion for at least the last 6 quarters. This one was only a $1 billion beat, both in terms of the revenue line and the guidance for next quarter as well. So this was the smallest beat in 6 quarters. Also, you've got to remember that it's beating by 1 or 2 billion, but now that's on a revenue base of 30 billion a quarter versus 10 billion, sort of 2 years ago, something like that. So it is a strong set of numbers, but it missed some quite high expectations.
There seems to be some concern around Blackwell and the production issues that the company has had. Is this just a tactical issue, i.e. we are going to get it sorted, we're going to get it sorted fairly quickly, and then we'll be up and running and actually yields will be good, and therefore the longer-term story looks better? Or is this more of a strategic problem that building these bigger, faster chips is going to become more and more problematic?
Yeah, look, so for context, Nvidia has been increasing the product cadence from 2 years to 1 year, right? So that's very complicated. And when you're ramping a new product, that's always going to have some issues. But the issue with Blackwell doesn't look like a big structural problem. It is, as you say, more of a tactical problem. It's going to mean a 1 to 3 month delay, something like that. And so that is not a worry. The other thing to say is that if there's people can't get hold of the Blackwell product, they can take the existing product Hopper. So it might mean a slight increase in the existing product rather than the new product. We're not concerned. We have other concerns longer term, but the Hopper execution and the Blackwell execution problem are not major concerns for us.
And those longer term concerns are?
Yeah, so look, we worry a little bit about digestion by the big cloud providers, right? So historically, every 6 or 8 quarters, there's a period of digestion by those cloud providers. That can lead to slightly slower growth rates. We worry about supply of electricity, actually, to be able to build these data centers. That is a constraint. And then obviously the big concern on the call last night was lots of questions around the return on investment on all this infrastructure investment. Jensen gave quite a long answer talking about all the different areas where AI can be used by businesses. So, costs and optimization, AI agents, digital advertising, targeting, things like that, medical, logistics, and so on and so forth. But the exact numbers on return on investment are not known. And also, do we get diminishing marginal returns from AI investment going forward? However, look, the current picture still looks pretty strong.
Just coming back to the digestion issue by the hyperscalers, when do they need to start to see a return in order to justify to their shareholders the level of investment that is going in?
Yeah, so it's very interesting, isn't it? They've made comments like there's a bigger risk in not spending than actually overspending. And that's because quite a lot of them have got quite fungible assets. Meta is a great example. It's got its Llama and its Llama models and all its new sort of AI focus, but it can also use AI and GPUs on its existing business. And they're seeing very, very strong returns there. So there are very, very high returns on investment from current digital advertising usages. But yeah, that's the problem. Because it's such a diverse area, companies are still in the sort of implementation or even the planning stages of these AI projects. And so the returns on investment are still very, very uncertain.
Let's talk about competition. It feels at the moment as if Nvidia is dominating the training space. When it comes to inference, though, that may be where the competition ultimately comes in. Is that how we should think about it?
Yeah, I think so. Obviously, Nvidia has got products and their products are used for inference. But yeah, that's right. So products from AMD, their MI300 product is more a inference type engine. And then you've obviously got the custom silicon from companies like Amazon. So that's their Inferentia chip and so forth. And so, yeah, there's going to be a bit more of a workload by workload. Inference is quite different often because it depends on what you're getting the computer to do. Training, particularly for large language models, that's very much the homestead or the area that's dominated by Nvidia because of the chips, but also because of CUDA and the operating system. So yeah, we're still breaking out the market shares, but companies like AMD have been extremely successful at taking market share from Intel, and there's a probability that they can take some share from Nvidia, principally because the big cloud service providers want a second source. They don't want to be beholden to Nvidia for both training and for inference.
Once that starts to unfold, do we get a shift in where the value lies within the AI space? At the moment, the value seems to be being captured by Nvidia. How quickly does that evolve?
Yeah, that's exactly right. So with all technological sort of transformations, you often see the picks and shovels. I've done this long enough to remember the 99 bubble, and the picks and shovels, the Ciscos were the ones that were really doing the heavy lifting to start with, and then that starts to flow into internet companies, and we've seen that with companies like Meta and Google using AI quite a lot. Then you're going to have AI infused into software, and you've started to see that a lot from Microsoft and from Adobe and Intuit and so forth, and Salesforce, who also reported last night. And then you're going to start to see everyday companies talk about how AI is changing them. We've already seen that from Walmart. So you get this gradual flow, but the place where they're really making money at the moment is definitely in the chip area, and that value shift will gradually shift into other areas, as I say. And then also the PC market. Let's not forget forget the PC market, AI PCs could become a sort of an ignition for that industry as well.
You bring up Salesforce CRM. Is that where the risk lies in this space? That the companies start doing their own CRM, they start doing their own software writing, they start using AI for that kind of technology, and it allows them to step away from the big providers. Where is the obvious risk at the moment that AI poses within the software space?
Yeah, I think it's actually to do with, I look at the digital advertising space, and that we're always focused on eyeballs and where eyeballs are going, because that is ultimately, what people can monetize. And one of the issues with AI assistants is that if you get people using an AI assistant as their sort of default, then they don't use the underlying interface of, say, Salesforce or even Google, right? They shift and they start to default to using an AI assistant. And that becomes, if you will, the operating system for all the other applications and infrastructure that you're using. And so companies like Salesforce maybe lose a little bit of their importance and value because you're not really dealing with the Salesforce software, you're dealing it through an agent.
Ben, you talk about kind of remembering what happened 99 into 2000. Any similarities?
I mean, there are some similarities in the sense that you've got this big infrastructure build, you've got some lofty valuations, but quite a lot of these companies, are very, very profitable, have very big moats, are very well managed and very agile. I keep talking about Meta, but it wasn't so long ago, 2-3 years ago, that Meta faced some very, very profound problems, and the agility with which they were able to navigate that has been, very, very commendable. So yeah, there are some comparisons. We watch that very, very closely, though. The big issue is growth. These multiples are justifiable if you continue to get the levels of growth that we think you can get, but once that growth starts to derate, maybe in 26, or we get a cloud digestion period, that's when the multiples can start to contract.
Ben, great stuff. Thank you very much indeed. Ben Barringer, global technology analyst, joining us from Quilter Cheviot. Thank you very much. Coming up, we're going to discuss the latest on the US-China talks. Senior White House official Jake Sullivan meeting top military figures. We're now getting a readout from his meeting with the Chinese President Xi Jinping as well. We'll bring you up to speed with all of that next. This is Bloomberg. The Chinese President Xi Jinping has told top White House official Jake Sullivan that he hopes the two nations can meet halfway. The two sides are seeking to stabilise, of course, ties this ahead of the US election, which is taking place in November. Joining us for now, an update is Bloomberg's Jill Desis. Jill, we're getting a readout from CCTV. What do we make of what we're hearing so far?
Well, look, Guy, as you just said, we're getting some initial Chinese state media reports on this meeting between the National Security Advisor, Jake Sullivan, and Chinese President Xi Jinping. We're really just seeing some very high-level comments right now about the importance for the continuation of bilateral ties between the world's two largest economies. Xi stressing there the need for stable U.S. relations. I think that's all pretty expected here because really, Guy, the importance of this visit from Jake Sullivan, I mean, this is the first time that the National Security Advisor from the United States has visited China in the last several years. He's already had some really high-level meetings with others in China, including a really top Chinese general of the People's Liberation Army. That's the Chinese major defense forces there. Also, Jake Sullivan's been meeting with Huang, that's the top diplomat in China. All of this is really about stabilizing the U.S.-China relationship during a really, really critical time. We've seen relations sort of sour, get a little bit better, but ultimately still remain strained over the last several years under both the Trump administration and now the Biden administration, and we're heading into a very uncertain time period where you've got this U.S. presidential election just a couple of months from now. We'll have to see what ultimately happens with the administration come into next year.
The Chinese are making very senior people available to meet with Jake Sullivan. What should I read into that?
Well, look, Guy, I think that, from the China perspective here, it's obviously very important that they keep ties with the United States stable, particularly, as I said, going into this election. So, look, you've had over the last several years, the U.S. really kind of tightened the screws on China and Beijing in a lot of ways. We've seen a lot of, major tariffs and other punitive measures put on Chinese goods. We know that the U.S. is, working very hard to kind of curb a lot of Chinese developments in advanced technology and manufacturing and such. I mean, we've seen this in the semiconductor industry, in electric vehicles in particular. From China's perspective, I mean, the economy the economic growth in China is certainly slowing down somewhat. They've kind of lost a lot of leverage that maybe they would have otherwise had to kind of push back against some of these curbs. From the China perspective, it kind of behooves them to make sure that ties remain stable, particularly if there's going to be any uncertainty about what's happening once the U.S. presidential election takes place.
So what message is Jake Sullivan going to take back to Washington with him?
Well, I think at this point, what they're ultimately trying to establish here is maybe some kind of bilateral meeting between both Xi and then, current U.S. President Joe Biden going forward. They've one of the big deliverables that it seems kind of came out of this already is some kind of promise that the two leaders will have a talk in the coming weeks. It's not really sure what form that might ultimately take, but then ultimately we'll have to see if Biden, who's concluding his term, he's not running for.
I think we may have lost Jill Desis. Let's assume that that's probably correct. Usually when the screen goes blank, you can assume that that probably has happened. So let's move on and talk about some of the geopolitical stories that we are watching. Israel has launched deadly raids into the West Bank. It's done so to try and combat what it says is terrorist activity. The raids are the latest surge in hostilities since the start of the war in Gaza. Palestinian officials say 10 people have been killed, whereas Israel says it killed 5 militant targets. The US is warning of an environmental disaster as an abandoned oil tanker in the Red Sea appears to be burning and critically leaking. The ship was carrying 150,000 tons of dense Iraqi crude when it was attacked a week ago by Iran-backed Houthis. We'll continue to monitor that story. We're also going to come back to the inflation story next as well. We have seen data out of Spain and Germany this morning indicating that inflation is cooling. Are both countries sending the same message on inflation? We'll discuss what it's all going to mean for the ECB next. This is Bloomberg.
I don't want us to be in a situation where we cut and then we have to raise rates again. Like, that would be a very bad outcome. It would really undermine all the confidence I was talking about people have.
Not everybody's as convinced as Powell is that everything is under control and we can declare victory. Atlanta Fed President Raphael Bostic remaining cautious about the timeline for cutting interest rates in the United States. He is definitely at the hawkish end of the spectrum when it comes to what we see on the FOMC. You probably saw it just before we went to break a few moments ago. We have now seen the German DAX surpassing the record closing high. So we've got an intraday high right now. Let's see whether or not we can close at that high. Obviously, that is the key metric by which we will judge this. But it's worth noting that that is happening on a day when we see significant weakening in German regional CPI data. We saw that at the beginning of this program. We have seen data coming down pretty much across the regions. And we are seeing a softening that is greater than anticipated, which takes us towards maybe a set of data a little bit later on in terms of the national numbers, which are going to deliver a similar outcome. You can see that the euro has weakened significantly on the back of this. We are now trading with the 110 handle, 110.84 on euro dollar. So some dollar strength coming back into the mix. The market is now pricing in near certainty that we are going to see a 25 bip cut when it comes to the ECB at that September meeting. Is that the right call? Jana Randau joins us now to give us her take on all of this. Jana, walk us through the market reaction, your reaction to this German regional data. Does it confirm that the ECB is going to be cutting?
Yeah, so what we're seeing out of the German states today is that inflation, or the inflation trend, is slightly weaker than expected. So we're seeing declines on the month, which suggests that the economist estimate for an annual rate of 2.2% in August might actually be on the strong side, and there might actually be a downside surprise. So slightly weaker than expected inflation in Germany. And of course, we've seen that in Spain this morning already. And then also for Italy, for France, and for the Eurozone, we do expect a retreat in inflation in August. Now, does that cement expectations for a cut in interest rates from the ECB in September? Probably. But that doesn't mean that the ECB is ready to declare its fight against inflation over, because we've also seen some other indicators that are speaking a slightly different language. And also, of course, policymakers have been cautious in saying that the road to 2% inflation is bumpy, so there might be setbacks in the months ahead. Inflation might tick up again. And that was the clear message from chief economist Phil. Yes.
Yeah, precisely, the Lane comments. Very cautious. How do they weight the CPI versus, say, some of the wage data they're watching as well? How do they kind of relatively see these various data series that they're watching?
Yeah, so the one thing that President Lagarde actually left us with going into the summer break was saying, look, we are dependent on data, but we're not dependent on individual data points or one individual data point. So inflation is one element that feeds into the ECB's assessment. You mentioned wages. They are coming down. We are getting another one in the coming months. And then, of course, projections. That's the most important thing.
Jana, always a pleasure. Jana Rando joining us out of Frankfurt. That wraps up this programme. We're going to continue the conversation. It is time for the brief. Manus Cranny is in New York getting ready. He will be joining you very shortly as we continue to count you down to the opening of Nvidia a little bit later. This is Bloomberg.